I'm going to ask you some questions about housing, Governor. So, my understanding of your evidence is that the major issue in the Australian housing market today is one of supply being deficient. Is that right?
Yes, there is, as I've said a number of times, we've got demand for housing and supply isn't able to meet it.
Okay. So, are you aware broadly the government in Canberra has significant supply policies, it has significant programs, Housing Australia Future Fund, housing targets, other schemes? You're aware of these schemes, I imagine?
Yes, I'm aware of those schemes, yes.
Okay. The government's been in power for over 3 years. You said after the recent interest rate judgment that you're not going to be confident it's going to make any impact in the next 2 years. So that was your comment in relation to the supply side. Why don't you think any change can be achieved on the supply side in 2 years?
Simply because, well, I didn't have, when I said that, it was sort of an answer that thought to me it takes up to 2 years really to get any momentum on approvals and construction and so on. What we're talking about here is high density. That stuff doesn't happen overnight. So I wouldn't take the 2 years as being, you know, precise, that exactly in 25 months we're going to have a boom in housing. I don't mean that. What I mean is that basically it takes time for approvals and building, and we know at the moment actually that construction is slow.
So can I ask you then about the demand side? Have you been asked by the government to do any analysis on the changes to the home guarantee scheme, the 5% deposit?
No.
No. Have you done any analysis internally on what that might mean for prudential stability?
No, we haven't done. We've looked at other people's estimates of what it might mean for housing prices, and that seems to vary between very little to 6-7%, but we've done none ourselves.
So what do you think it will do to house prices in the short term?
In the short term, it's possible that housing prices might be a bit higher than they otherwise were.
Right. You think it'll be a short-term impact or medium-term?
Well, it depends again on how supply responds, and we are seeing a lot of movement in supply. Certainly in New South Wales there's a lot of movement there.
Sure, but when you say higher, I mean, what sense do you think?
I've done no analysis on how much higher housing prices will be in response to this. None.
Okay, and has the bank done any analysis on that?
No.
Okay. Is that something that you can take on notice?
Well, there's no need to take on notice whether or not we've done any independent analysis of it. We haven't. If you're asking will we do work on it, it'd have to figure in our priorities, and I'm not sure that specifically at the moment is one of our priorities.
I understand this is a matter for APRA as the prudential regulator, that they have to make judgments about these things, but you do also have a whole of economy role and mandate. So lending policy, as we've discussed in the past, partly does have some relevance to the RBA, doesn't it?
It does, and that's why we do have a great deal of dialogue with APRA, and one of the recommendations of the review is that we put our macro-prudential work with them on a much firmer footing, which we're doing.
It's National Banana Day, in case you didn't know. Very important to the Queenslanders. Now, the issue is, though, that there will be potentially higher... I mean, even the Treasury has said that there will be higher prices. Some of the market economists have said that there could be 5-6%. Some have said it could be as much as 10% increases. Now, we're talking here about entry-level prices, aren't we? Entry-level first homes.
Yes. I'm unsure what the question is. Yes. Yeah,
okay. So there's potentially a price impact, as you say in your own... I mean, I'm not seeking to verbal. I mean, you've said in your own words you haven't done the analysis. You said before that it's possible there could be higher prices. The other factor here, of course, is that there will be people with much higher loan values. So they'll have higher LVR arrangements, won't they?
Yes.
So what is your... Do you have any thoughts on more people having higher LVRs in the community?
Well, they just have to be aware that even though it's under this policy, instead of having lender's mortgage insurance, they basically have a backing of the government.
Yes.
But they still have a much higher loan-to-value ratio, which does mean that if they do find themselves in difficulties, which, hopefully they don't, but if they do, then the collateral value underlying that, there's a risk that that may not cover the loan. If housing prices decline, then it doesn't take when you've got a high loan-to-value ratio, it doesn't take as long, as much for housing prices to decline, and you're in negative equity. That's the main outcome of having a high loan-to-value ratio.
But the other point to make, of course, is borrowers in such a situation will face higher payment costs,
well.
and they'll take that into account when they're deciding how much to borrow and whether to get in with a small deposit or wait a bit of time.
So those are the two risks to individuals. Those are the two major risks to individuals. Is that right?
Well, they're risks to individuals in the sense that they've got to meet their higher loan repayments, and it's possible that they may not be able to recover the cost of the loan. If the housing prices decline, they need to sell, but then ultimately that's a risk for the banks.
But that risk is mitigated.
Is there how's it mitigated? Sorry.
Well, there was
the government guarantee.
Questions from Senator
The government guarantee is what happened before was that there was lender's mortgage insurance to give the financial institutions comfort that if something happened, they would still get their money back. Now the government's filling that.
So those are the risks that the individuals may face because they have potentially bigger loans as a result of this policy. And then what about the macroprudential risks?
Well, what do you mean by macroprudential risks specifically?
Well, we've discussed in this committee before the fact that there are macroprudential tools which are deployed by your sister or your brother regulator, but my understanding is that there is some consultation amongst the Council of Financial Regulators, or certainly with the Reserve Bank, about whether those macroprudential tools are appropriate in their current design. I understand that that's something that...
Well, there's the macroprudential tools at the moment. There's a serviceability buffer.
Yep.
And that's basically it. There were some macroprudential tools back in 2014, 2017. Now they've been removed. The main focus from a macroprudential perspective is the share of loans that are made at high loan-to-value ratios,
right,
and the share of loans that are made at high debt-to-income ratios. Both of those things, they don't necessarily, high debt-to-income doesn't necessarily result in high-risk loans, but they're the things that we're watching, and we're watching with the Prudential Regulator APRA.
Okay, so as a result of the Home Guarantee Scheme being opened up and having the income caps entirely abolished, will there be more people with high LVR loans? Will there be more people with high debt-to-income ratios?
Well, probably. We haven't seen the hard data yet, but probably. To Chris's point earlier, though, it does mean that people have to pay more out of it. If they've got a higher loan-to-value ratio or a high debt-to-income ratio, they're going to be paying more in housing repayments. And actually, quite apart from that,
Excuse me. So, sorry, your point is that they have higher repayments as a result.
They have high repayments, so they've got to take that into account when they decide whether or not to take out these loans with this guarantee from the government. What we know prior to this is that a large chunk of people did not borrow up to the maximum amount they were permitted to borrow, and that usually probably would reflect the fact that they weren't comfortable allocating that much of their income into repayments every year. So will everyone rush in and immediately go and take 95% loan-to-value ratios? I'm actually not sure they will. Some will, but I still think a large portion will think before they borrow up to the maximum they're allowed.
So I guess then we go back to this issue of the macroprudential impact. So more people having higher LVR loans, more risk in the system. What does that mean for the overall position?
Well, as I said earlier, the risk to the banking sector is mitigated because they don't have
Sovereign guarantee.
lenders' mortgage insurance anymore. What they have is a guarantee from the government. So all it means is that the risk is now on the government rather than the lender's mortgage insurance.
Yeah, so it's the household sector. I guess yes, sorry.
Yeah, we're at 10 minutes. I think a couple of your colleagues got a couple more questions, so if we could.
Oh, I've got quite a lot more. So what do you want to do?
Well, we've only got the Reserve Bank for 10 more minutes. Susie's got some questions, I've got some questions, so we might have to put some on notice.
Can you put some on notice?
I guess I can put some on notice. I wanted to understand exactly your position on this. So the exchange we just had before, I think, was that there would be the risk transferred or effectively default from the private sector to the government. Is that right?
Yes, so the way it works is that if you had a loan to valuation ratio of 80%, you would have to get lender's mortgage insurance and pay for lender's mortgage insurance. Now, for the first home buyers, under the new policy, they don't have to get lender's mortgage insurance, the government guarantees.
It's on the government, right?
Yeah, so if they default, the government pays.
So it's gone from the private sector providing it to the taxpayer.
Yes.
Okay, thank you for clarifying that. The second issue is in relation to the risk. There is higher risk in the household sector, isn't there, as a result of higher LVR loans?
Higher LVR, yes, that's right. So individuals taking on higher LVR loans do tend to be riskier because obviously their collateral is not going to cover as much of the loan if the price declines.
So the overall household sector faces now more risk in Australia?
At the margin, there is, again, depending on how many take this out, and you've got to remember that this is a small margin over the total stock of housing loans, which is massive. So I'd say at the margin, maybe, but it's, this is the flow over the stock, and the stock is huge.
Okay, my